So a lot of you out there are saying, marry the house, date the rate. Don't worry, interest rates are going to fall down. Okay, let's look at some empirical evidence of rates going down. Okay, and why they went down um, in 2008 and also in 2020, and we have to figure out how rates go down and why they go down. It's not just the 10-year. It's not just short end yield curve. Uh, it's not just foreclosures. It's not just all these other things. Uh, the Fed plays a very big role, and it plays a very big role in mortgage-backed securities. So let's look at 2008. What happened? So in this chart, you'll see the MBS spread versus a 10-year, and you can see pretty much from 2004 to early 2007, it was pretty flat. Okay, Fed wasn't buying any mortgage-backed securities. 10-year was pretty stable. Fed fund rate was stable. And then in '07, what happened? Defaults started jumping up. Liquidity started disappearing in the market. Banks didn't want to lend to each other. They had a lot of credit default swaps and counterparty risk, so they didn't want to lend. So what happened? Mortgage rates shot up a little bit. And then what happened? If you see the green line, that's when the Fed stepped in and started buying. That's November 2008. November 2008, that's when the Fed started buying mortgage-backed securities and made the announcement. The Fed fund rate didn't go down until December. That's when they started changing the Fed fund rate. So you can see clearly there, especially in secondary market, that mortgage-backed security spread fell right away as soon as the Fed came in, was a buyer of last resort, and basically saved everybody by buying up all those bad mortgages. And then interest rates went from October 2008 at 6.46% on average to 4.96 in January. So like in 2 months, we saw a 1.5% drop in mortgage rates. That's a big amount, and the spread like came down as the Fed fund rate came down, the 10-year came down, but it was really the mortgage-backed security purchase operation that started the whole reducing the rates. And if it wasn't for that, the spread would have just kept on going because who's going to buy those mortgage-backed securities? So you see right here, the Fed is important when it comes to mortgage rates. So in this graph, in this chart, we're looking at the MBS security spreads versus a 10-year from 2012 you can see pretty much early 2022. 2004 so you can see clearly early 2007 interest rates went down. It was pretty as flat. The Fed kept on buying mortgage-backed securities, which is Fed wasn't buying any mortgage-backed securities. The brown lines, 10-year was pretty stable at the bottom there. Fed fund so rate they was kept stable. Buying. Interest rates were kept on going down. The Fed fund rate was default started jumping up, and then they kind of like leveled off for a while, disappearing in the market. Banks didn't want to lend to each other. They had a lot much. Default swaps pretty flat and from 2015, so they didn't want to lend. So what happened? Mortgage rates shot up. I would say like 2015 to 2020. And why is that? And then what happened? Because the Fed started. That's when the Fed stepped in and started buying. And the less they bought, 2008. The less support there was November 2008. That's when. But at the same time, the market was doing fine by itself because Fed fund rate was still very low. Fed fund rate didn't go down. There were until December. No issues in foreclosures anymore. A lot of them were done. So rates were you can see kind of flat clearly there, especially in the secondary market, that everything was going great. Mortgage-backed security. So Fed pulled out, and right away, the spread as soon as the Fed the same came in, much was a buyer of last resort. So mortgage-backed securities were basically saved mid fours to like buying up a little bit higher than 3.5% all those bad mortgages. From 2015 all and then interest rates went from October because there was 2008. The Fed was not buying anymore. There was no average risk out there. To 4.96 all payments themselves in January. So when the Fed basically like in 2 months came off, we saw 1.5% drop in mortgage rates. 2019. That's a big amount. And the spread like the
came
rates
down.
just went flat.
They were like at
As
3.
the Fed fund rate came down, the 10-year came down
8%,
but it
and it's
was
flat. They didn't
really
go
the mortgage-backed
They didn't
security
go up. They didn't go down.
purchase
Because the market
operation
was
that
fine,
started
and the Fed wasn't
whole,
buying, so there was no buyer
the last
reducing
resort.
the
But
rates. There was no risk,
and if it wasn't for that,
for investors.
the spread would have
And
just
then
kept on
2020
going
hit.
because
And
who was
what
going to buy
happened?
those mortgage-backed securities?
Rates started, the
So
margin started shooting up.
you see
rates
right
started
here,
shooting up a little bit.
the Fed is
And then
important.
the Fed came in
when
and
it
started
comes
buying
to
a ton of
mortgage-backed
mortgage-backed
securities.
And as soon as they bought,
in
what
this
happened?
chart, you'll see the
Rates fell.
MBS
spread
spread versus the 10-year.
They went zero with the
And
Fed
you can
fund
see
rate
pretty much from
2004 to
early
so
2007.
interest rates went.
It was pretty flat.
3.6 to
Fed
all the way
wasn't
down
buying
to
any mortgage-backed securities.
2.71, I
10-year was
believe,
pretty stable.
back in January
Fed fund rate was
2021.
stable. And
So
then in '07, what
rates
happened?
really fell in
Default
conjunction
started
with
jumping up.
the Fed fund rate going to
liquidity
zero
started
and
disappearing in the market.
having the
banks
10-year
didn't wanna lend to
falling
each other. They had
and the Fed
credit
coming in
default
and
swaps,
taking away any
risk
risk
and counterparty risk
by
so
buying
they didn't
back
want to lend. So
mortgage-backed
what happened?
securities.
Mortgage rates.
So you need
shot
to
up
have
a
all
little bit.
three to have rates really start
and then what
moving
happened?
downward and
If you see the
reducing
green line,
spread.
that's when the Fed stepped in.
But where are we now?
And started buying.
Now,
That's November.
September
2008.
2022, the Fed
November
stopped
2008.
buying
That's when
mortgage-backed
the
securities.
Fed started.
And as soon as it stopped buying
mortgage-backed
mortgage-backed
securities,
securities,
made the
prices
announcement.
fell.
The
The spread went up.
Fed fund rate didn't go down,
and
until
it went
December.
higher than
That's when they
the
started changing
10-year.
Fed fund rate.
The 10-year
So,
was hovering in the
You can see
high
clearly
threes,
especially in secondary
almost
market,
at the 4, but under
that
4. But
mortgage-backed security
mortgage rates kept on going up.
spread
Uh,
fell right away
because
as soon as the Fed
There's no
came
more
in,
support.
was
There's
a buyer
zero
of last
support for
resort,
mortgage-backed securities.
and
So what
basically
will
saved
happen?
everybody.
Let's say in 2
by
years,
buying up
inflation's beaten
all those bad mortgages.
Fed says, okay, I'm
Um,
done,
and
I can
then
start,
interest rates went from October to now
2008
raising rates at 6.46%.
Great.
Average.
So 10-year will go
to
down.
4.96
will go down. It
in
won't go
January.
to zero, that's for sure.
So like in 2
but
months,
we could have a
we
little
saw
bit lower rates.
1.5% drop
But
in
are you?
mortgage rates.
Can you really expect
That's a big
much
amount.
lower rates?
And the spread
Because
like,
if the Fed
came down.
doesn't buy
again,
as
it
comes in
the
into the
Fed fund rate
market,
came down, the 10-year came
look
down.
at what happened between
But it
2018
was
and 2020.
really the mortgage-backed security purchase operation that started the whole
okay?
reducing the rates.
There were flat margins,
and if
with
it
the
wasn't for
10-year.
that,
So if the 10-year doesn't go up
the
that,
spread would have just
that
kept on
much
going
down,
because who was going to buy those?
and the Fed is not
mortgage-backed
buying,
securities?
you're not going to
So
see a whole
you
lot
see
of
right here,
mortgage rates going
The
down.
Fed is important.
So maybe we
when
can
it
go up
comes
to 10%,
mortgage rates.
but then what's going to happen?
So
we're not going to
in
see
this chart,
5%.
you'll see the
We could
MBS
spread
maybe versus the
7%.
10-year, and you can
high
see
6,
pretty
but
much
like
from
people believing
2004 to
5.75 and
early
below
2007.
4.
It was pretty flat.
You're not going to see that
Okay,
because
uh,
if the Fed doesn't
wasn't
come in
buying
to
any
buy,
mortgage-backed securities.
they cannot
10-year was
actually
pretty stable.
mortgage
Fed
rates
fund rate
down
was
because the
stable.
risk will
And
still
then in
exist.
07, what happened?
And there's another thing that's
Default
very
started
important is
jumping up.
when it comes to
liquidity
mortgage-backed
started
securities, if you're an investor and you want to buy
disappearing in
them,
the market,
okay,
banks didn't want to lend to
you
each
want
other.
to
They
know
had
what's
a
the
lot of
prepayment. You
credit
love
default
prepayment
swaps
because you're getting your
and
money back
counterparty risk
quickly.
so they didn't want
And
to
you have
lend.
a
So
lot
what
less
happened?
risk.
Mortgage rates shot up a little bit.
With a recession,
Um,
there's going to be less
and then what happened?
prepayment.
If you see the green line,
What
that's
happened
when the
in
Fed stepped in.
2021, it was
and started
fantastic
buying.
because
That's
a lot of people
November
refinanced. So a lot of these
2008.
mortgage-backed securities were
November
getting paid
2008,
off
that's when the Fed
because people
started
refinanced.
buying mortgage-backed securities.
But in a
and
recession
making
and a
announcements.
slow economy, we're not going to see
the
prepayment.
Fed fund rate,
So
didn't go down,
investors are going
until
to have
December.
a lot higher
That's when
risk,
they started changing.
and they
the
don't
Fed
want to
fund
see
rate.
that. So that's
So
why we're not going to see a lot
You
of
can see clearly
change
there,
in
especially in
the
secondary market,
mortgage
that
interest rate.
mortgage-backed security
After the Fed
uh,
pivots,
spread fell.
we'll see a little
right
drop.
away as soon as the
But don't
Fed
expect,
came
going
was
from
a buyer
10%
of
to
last
5%.
resort,
I don't think that's going to happen.
and
I think you'll
basically
probably
saved
see 7
everybody.
to 6%.
By
Probably
buying up
more towards the 7%.
all those bad mortgages.
So people
And
saying
then
buy
interest rates went from
know,
October
buy a house now.
2008
Don't worry, you're going to
6.46%,
refinance. You might be just refinanced
average,
exactly at the same rate as today.
to
4.96
after we go up to
in
10%.
January.
Yeah,
So,
like
marry the
in 2 months,
marry the house, date the rate.
we saw 1.5%
Could be very
drop
risky.
in mortgage rates.
So
That's a
hold
big
on to your
amount.
hat. It's going to be a
And the
bumpy
spread
ride
like
in the real estate market.
came down.